markets managed to find a little bit of a reprieve. Perhaps they might have found more. Looking at the U.S. economic calendar today, we finally get a little bit of economic news to chew on, and it's a little bit brighter than expected, at least at first blush. So why the reticence? What can we expect from here? That's what we're going to tackle on Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And we are going to set ourselves up here for a little bit of a Fed policy speech over the weekend by unpacking what is, at surface level at least, looking like a little bit better economic data out of the U.S. and a little bit of a step back from the extremes that we saw in April, maybe. Then see if perhaps what we then hear from the Fed might be encouraging, or if in fact we are in a situation where the market's reticence is telling us that the backdrop here is becoming somewhat undigestible, regardless of what the central bank might do or not do near term. So let's pull apart here what this data gave us and see if we can in fact hang some optimism on it. This is the full breakdown over the release schedule overnight, and we can see here that what we have is purchasing manager index data for May from across some of the major economies, and I've highlighted the composite figures here to kind of get a sense of overall growth, taking in both manufacturing and services in these major economies. As ever, this data is done around a center line of 50, where 50 is neutral, above 50 is growth. In this case, economic sector activity growth. So if you get a, let's say, manufacturing reading above 50, what that means is the manufacturing sector is growing. Economic activity in manufacturing is growing. If you get a reading below 50, that's contraction. So economic activity in the sector is contracting. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So as we go down the list here, we can see signs of weakening performance globally until you get to the US. So in Australia, the composite index pointing to slower growth versus the prior month. Although you still have growth, you're near standstill. In Japan, you've gone from growth into contraction mode. In the euro area, you've gone from very modest sort of standstill-like growth to contraction mode. Notably, this is worse than expected. In the UK, same thing, contraction mode for another month, albeit the pace of contraction eases a little bit, so you go from 48.5 to 49.4. But then you get to these US numbers, and here the expectations were pointing to ongoing standstill after the preceding months. Standstill in manufacturing, standstill in services, holding basically within a hair of 50. What you got were numbers that were significantly more encouraging, it would seem. So 52 and change here across the board, suggesting that growth rebounded in May after what was a very difficult month of April, which we can see here gave us some of the weakest growth that we'd seen out of the U.S. in 19 months. So ostensibly, this is good news. We've talked a lot about the idea that the global economy is basically powered by three growth engines: the U.S., the Eurozone, and China, which collectively make up 58% of global GDP. The remaining 42% are mainly vendors to the former three. So think Mexico and Canada in the U.S., or the commodity producers in Southeast Asia or Latin America or Africa or Australia, for that matter, and China. Think about Central Europe, Nordic Europe when it comes to the Eurozone. So there is a very significant amount of weight on just three economies to really be the source of demand that powers things. And of course, China, in its kind of spot in the middle of the global supply chain, is itself dependent mainly on demand from the US, but also, of course, the Eurozone. And so those are kind of end demand markets. And so what's particularly interesting about this PMI data set, of course, is that we got updates on where US and Eurozone economic growth sits. And that's after, in the April month of surveys, it was a 17-year low on global growth. And that 17-year low came as the US basically ran out of capacity to offset weakness elsewhere. The story of last year really was that growth in both the Eurozone and in China ground to essentially a halt. Meanwhile, the US was powering on because of a strong service sector. And in the US, the service sector is mainly serviced by domestic demand. And so that strength in the US didn't very much spill over. Most of what happens cross-border, most of the way that US demand spills out across borders is trade. Most imports are of goods, not of services. So you have a situation here then where the story really since the middle of last year, since right about here, was that the US is having a boom, and that's keeping overall global growth at least somewhat positive. You can see that right here. It's basically keeping it anchored, although it's drifting a bit lower. But it's not until the beginning of this year that you get this sharp push down, and you hit 17-month lows in April, as though the whole thing is starting to unravel. And that happens, if you look at the US set of PMI numbers here, as the US service sector cools and activity slows. And you can see here, this is the May set of numbers. They're unquestionably better than the April set of numbers. That much certainly seems to be the case. Growth has accelerated. But it's still very much on this downside trajectory whereby it's catching up downward on Europe and the situation in China. And we can see here in Europe, even this somewhat moderating story where manufacturing is shrinking at a slower rate, you still have a sharp fall back in the composite because the service sector falls into contraction territory as well. In fact, what we have here for the Eurozone is really quite shocking, really. We have the weakest service sector growth in Europe since January of 2024. So we're going back over here. And this was something of a kind of mild recession at the in the Eurozone in the tail end of 2023. So of the main engines here, this one continues to look weak and is in fact looking weaker. This one is to some extent still dependent on demand from these two, and mainly the US. And so in seeing these US numbers, you kind of get the sense, okay, well, the linchpin didn't give way in May. But then you look at the internals of this report, and it starts to give you a little bit more of a sobering perspective. So first and foremost, the growth that you see in the numbers here seems to again amount to tariff front running. We can see here an absolute surge in stocks of purchases, that is to say, inventories. So there is a massive restocking effort that seems to be underway. In fact, taken together, both manufacturing and services, you have the biggest inventory surge since the PMI data on this score begins 18 years ago. And that, understandably, if you read the details of the report here, speaks to the tariff cliffhanger that comes in early July and then again in early August, when reciprocal tariffs above 10% start to be a risk again. The 90-day reprieve that keeps them at the 10% level expires for most economies in early July, and then for China, they're looking at a 30% tariff, but the reciprocal floor is 10, and then there's some extras there for punitive tariffs around the fentanyl trade and things like this. So the effective tariff is 30%, but that reprieve on the reciprocal tariffs above 10 for China, that expires in August. So there's cliffhangers here coming up, and much as we've seen before, businesses are stockpiling rapidly to try to front-run that. Moreover, bottlenecks have become more acute. We can see here the delivery times scale. So this would be delivery times declining. This would be delivery times going up, because, of course, this is an inverted sort of thing. And, of course, delivery times lengthening or shortening, somewhat of a different scale on the 0 to 100 and around 50 measure. So what you find here is that delivery times have lengthened considerably. In fact, you're going back to kind of the middle of 2022 for a reference point, maybe a little bit later, like September, October of 2022. And that speaks not only to tariff barriers, but also to this rush to restock. But then on the inflation side, and this is for both manufacturing and services, you see an absolute surge in costs. In fact, since the restocking is most aggressive on the manufacturing side, not surprisingly, this is where the cost pressure is greatest. Moreover, you can see that the difference between input and output prices is narrowing, in the sense that output prices are surging, which tells you that businesses are passing the costs on down the supply chain. So massive inflation here. In fact, the indication is that you're looking at price growth unseen since August of 2022, which is about a month or two, depending on which indicator you look at, removed from the post-COVID peak. CPI, for example, peaks in June of 2022. Before then, it starts to succumb to the Fed's rate hike efforts and comes down. So, and of course, supply chains get mended, and there's a constellation of factors there. So, the upshot here is, yes, there appears to be more economic activity, but that economic activity appears to be fueled by something inherently temporary, the front-running of tariffs ahead of another policy cliffhanger. Moreover, what you have is a surge in prices because the entire sort of act of trade has become more difficult and more expensive. And both sectors, services and manufacturing, end up cutting jobs. That is to say, they're not expecting this surge in activity to extrapolate forward. They're not looking at this as something that begins a revival of demand. So this is inherently something that is driven by a policy risk rather than by expectations for consumer uptake, or at least certainly there's hope for that uptake here, but it doesn't say anything about that uptake being there. And in this, it makes it look very much like the first quarter, where, of course, we saw a surge in imports, a surge in inventories, but consumption was actually the weakest it had been in almost 2 years, going back to the second quarter of 2023. And if we look at what matters for GDP growth, it is consumption. consumption is 68.5% of overall GDP. Looking at the components for both inventories, which fall into non-residential investment, as well as for imports and exports, and you net those out to get the impact on GDP, you're looking at a pittance. In fact, the trade component is less than 5% of the whole thing when you net it out, as compared to almost 70% for consumption. And so you get this sense that businesses are building these inventories. They're trying to front run the tariffs. They're straining supply chains and fueling inflation. But there's no guarantee that consumers are coming to buy this stuff, which is what you'd need to actually grow the economy. You see in the numbers that we've seen so far leading into the second quarter, weak retail sales. You saw the front running in March. You don't see it in the subsequent April report. So going into the second quarter, you already see that consumers are defensive despite the fact that businesses are being goaded to front run. Consumers are holding back. That's despite the fact that goods inflation really didn't surge in the April numbers, as many people feared. And the reason it didn't, even though we can see here that at the wholesale level, this is the PPI data now, they jumped to some of the highest levels since early 2023, we can see that businesses ate those gains and took the hit on margins. This is the drop here in the PPI for trade services, which is a sharp 1.6% squeeze on margins, and basically told you that businesses ate the extra costs for consumers. That would be these extra costs right here. We can already see, obviously, going into May that costs were on the rise. So those extra costs get eaten by businesses and consumers still don't come. Moreover, consumer confidence sinks to levels unseen since the lows post-COVID, and inflation expectations surge way above levels that the COVID peaks had it, as far as consumers' one-year inflation expectations. So consumers are, by all measures, very gloomy and reluctant to spend. That they're expecting prices to be this much higher ought to be a magnet to spend now, one would think. That there is a cliffhanger on these tariffs might be a reason to spend, to front run them, much as businesses are. But that is not what we are seeing here. And so you arrive at a situation then where businesses are building all these inventories, but perhaps there is no one to do the buying. And without that, there is no economic growth. So yes, at the headline, it seems like these numbers push back on stagflation risk this month, in the sense that the inflation is there, but the stagnation maybe isn't quite so quick to come. But under the surface, what you see is a recipe for sharper stagflation downwind. And so, as consumers are essentially driven away, despite what stockpiling occurs, and then perhaps eventually you get to a point where the inflation side of this craters under weak demand, which is, of course, exactly where you have the Federal Reserve step in. We have a speech this weekend from Fed Chair Jerome Powell. Against this backdrop, he seems unlikely to give the markets any more clarity, and they've reduced rate cut expectations now to just 89 basis points over this year and next. That's about 50 basis points this year, 50 basis points next, almost in line with Fed expectations, a little bit less dovish. The Fed sees a full 100 basis points, and the markets are almost there. So you can basically say that we're in a kind of holding pattern here. But what all of this suggests together, if Powell confirms as much, is that the Fed is going to have to wait for the brutality of the economic downturn to really hit inflation hard enough that it can cut to support growth without worrying that it will unmoor inflation expectations, which means waiting longer. And of course, what that makes for is a tolerance for more of a growth downturn. We see something very similar from other central banks this week. And of course, what that means is perhaps stocks are not confused in their soggy response in the face of today's data after yesterday's sell-off. They ultimately pause to consider and don't make much headway. We'll see how markets open next week. We have a holiday shortened week with Memorial Day, but the internals and the components of what's shaping up here are not nearly as rosy as would seem at first glance, and the markets appear to be wise to it. And this is Macro Money for today. As ever, we are here right after overtime. Show I co-host with Dylan Radigan and Chris Vecchio Monday through Thursday. I'll be back for Futures Power Hour with Chris tomorrow, as I am every Friday. I'm also on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call, although not next week on Sundays, usually on Sundays, but we have the holiday, of course. I'm also writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Thanks very much for watching. Macro Money is back next week. Happy trading.